Hello and welcome to my channel, Accountancy Step by Step. I am an M.Com postgraduate and I will teach you accountancy with the help of my YouTube channel. Today we will learn about generally accepted accounting principle, which is also known as GAAP. These are the principles, concepts and the rules which will be asked when you will go for the finance interviews. So let's start. Here we go.
Generally accepted accounting principles. So these are the GAAP in short form, refers to the rules or guidelines adopted for recording and reporting of the business transactions in order to bring uniformity in the preparation and presentation of financial statements. For example, one of the important rule is to record all the transactions on the basis of historical cost, which is verifiable from the documents such as a cash receipt or any other receipt for money paid. This brings in objectivity in the process of recording and makes the accounting statements more acceptable to various users. The example given is like we should have a proper documentation or proof of payment or any hard copy which we can show to prove that the transaction or the recording is correct. So in the previous chapter we have learned the meaning of accountancy. Accountancy is identifying the financial transactions, then summarizing, classifying into the proper heads, and then recording of the financial transactions and then reporting to the users, right? So reporting and recording both are based on each other. So if the recording is reliable, then the reports will be reliable and anyone can easily trust on those reports. So for that we should have some principles, concepts and the rules on which basis we are recording our transactions. So here generally accepted accounting principles which are accepted generally to record the transactions. Here are 13 principles, rules or concepts which we use for recording the financial transaction. The basic concepts of accounting, or these are the basic accounting concept of GAAP. First is business entity, money measurement, then going concern, accounting period, cost or historical cost concept, dual aspect, revenue recognition or the realization, matching concept, full disclosure concept, consistency, conservative or prudence, materiality and objectivity. Now we will study deeply about all these 13 concepts. Number 1 is business entity concept. Business entity. We have earlier studied that business has a different entity and the owner has the different entity. So this is based on that concept. The concept of business entity assumes that business has a distinct and separate entity from its owners who are introducing the money and with different entity, and the business which they are running is different entity. It means that for the purposes of accounting, the business and its owners are to be treated as two separate entities. If I am going to start any business of, let's say, selling of goods, so selling of goods is my business of selling of goods is with a different entity and I will be the owner with a different entity. Keeping this in view, when a person brings in some money as a capital into its business, like I am introducing the capital in the business, in accounting records, it is treated as liability of the business to its owners. Then, of course, if the business entity is different, business has to pay it to me further. So, this will be the liability for the business. Here, one separate entity or the owner is assumed to be giving money to another distinct entity or the business unit. So a recording should be done keeping in mind that the business owner and the business both are the different entities, separate entity. Keeping this in mind, then we will do the recording of the financial transactions. The second concept is money measurement concept. The concept of money measurement in terms of money states that only those transactions and the happenings or the economic events happening in an organization which can be expressed in terms of money, such as the sale of goods or the payment of expenses or receipt of income. So everywhere if cash or the money measurement is involved, etc., are to be recorded in the books of account. Earlier also we have studied in first chapter that in financial transactions in accountancy we only consider those transactions which we can measure in terms of money. So this concept is basically based on that money measurement. All such transactions or the happenings which cannot be expressed in monetary terms, for example the appointment of a manager, capability of its human resources, or any conversations going on, or anything, any decisions which cannot be measured in terms of money, or the creativity of its research department or the image of the organization among people in general do not find a place in the accounting records of a firm. So only those transactions we will record in our books of accounts which we can measure in terms of money. Apart from money measurement, if we cannot measure in terms of money any transaction is there, then we will not be able to record those transactions. The third concept is going concern concept. Going on concern concept. So going means which is going, which will go in future, keeping in mind that if we are running a business that will be going concern, that will not stop in near future. The concept of going concern assumes that a business firm would continue to carry out its operations indefinitely, that is for a fairly long period of time. It will not be like for 1 year or for 2 years. Okay, so that will be indefinitely. We are not sure for how long we will run that business and would not be liquidated. Liquidation means conversion into the cash, which will not be liquidated in the foreseeable future. This is an important assumption of accounting as it provides the very basis for showing the value of assets in the balance sheet. So the recording should be done keeping in mind that our business will go for infinity or for very long period. We will not close it in near future or long future. The fourth concept is accounting period concept. Accounting period that can be for 1 year, that can be for 9 months. Okay, so accounting period should be there. Accounting period concept for recording. What is that? Accounting period refers to the span of time at the end of which the financial statements of an enterprises are prepared. This is the time lag. End of which time lag? All the financial transactions need to be prepared to know whether it has earned profit or incurred losses during that period. So that particular period should be there. Like let's say for 9 months or 12 months, might be it happens for from January to till December or from March till April. So there should be the defined accounting period. And what exactly is the position of its assets and liabilities at the end of that accounting period. Such information is required by different users at regular interval for various purposes, as no firm can wait for long to know its financial results, as various decisions are to be taken at regular interval on the basis of such informations. So of course the records will be maintained, and on the basis of those records the reports will be maintained, and for the reports everyone will be waiting for. So there should be a predefined period. For that period, after the end of that particular period, the financial institutions needs to prepare the financial records. So there should be the defined accounting period. This is called the accounting period concept. Now number 5 is the cost concept. Cost concept requires that all the assets are recorded in the books of account at their purchase price, at which cost they are purchased, which includes the cost of acquisition, transportation. Now in the purchasing cost we will include the acquisition cost, then transportation cost, installation cost, and making the asset ready to use. All these will be the part of the cost. To illustrate, on June 2005, so this is an example, an old plant was purchased for 50 lakhs by XYZ Enterprise, which is into the business of manufacturing detergent powder. Okay, an amount of 10,000 was spent on transporting. So transportation will also include, and plant to the factory side. In addition, 15,000 was spent on the repair of bringing the plant into the running position. So these are the further expenses which needed to do to start the business, and 25,000 on its installation. Further 25,000 has been incurred for the installation. So the total amount at which the plant will be recorded in the books of accounts would be the sum of all these, right? So cost concept will say that the purchase price or the total cost incurred, if we have started any business, if we have purchased something, so total cost incurred on that particular asset or anything, that should be recorded in the financial transactions, right? So this is called the cost concept. Sixth is dual aspect concept. So this is very important in terms of recording. Dual means double. This is also called the double entry concept. Dual aspect is the foundation or the basis principle of accounting, right? It provides the very basis for recording business transactions into the books of accounts. This concept states that every transaction has a dual or the twofold effect and should therefore be recorded at two places. If we are doing any transaction, then it will have two-sided impact. If left hand side will be recorded, then of course there will be some impact on the right hand side also, or the debit, and something will be credit also. In other words, at least two accounts will be involved in recording a transactions. This can be explained with the help of an example. Now we had already discussed about the accounting equation that was also based on the dual aspect concept. So now let's see this example. Ram started business by investing a sum of 50 lakh. The amount of money brought in by Ram will result in increase in the assets, right? So if he is introducing the cash as a capital, then the asset will be increased by the business. At the same time, the owner's equity or the capital will also increase by an equal amount because he is introducing the money. So Capital will also increase or the liability. It may be seen that the two items that got affected by these transactions are cash and the capital account. So for recording of the financial transactions, everywhere double entry system will be there, and dual aspect concept says that at least two accounts will be impacted for doing any financial transactions. Number 7 is revenue recognition, realization concept. The concept of revenue recognition requires that the revenue for a business transactions should be included in the accounting records only when it is realized. When it is realized. That is not saying that when it is received, when it is realized, right? Here arises two questions in mind. First, in is termed as revenue, and the other when the revenue is realized, right? Revenue recognition or the revenue realization. So two terms are here. What is revenue and when it is realized? Let's take the first one first. Revenue is the gross inflow of cash arising from the sale of goods or the services by an enterprises. Right? If we are doing any sale purchase business, if we are selling something, selling any goods or services and receiving any cash flow, then that will be our revenue. Used by other of the enterprises resources yielding interest, royalties or the dividends, which is to be used by other parties. Secondly, revenue is assumed to be realized when a legal right to receive it arises. That is the point of time when the goods have been sold or services has been rendered. So, if we have sold something, doesn't matter when the third party has made the payment. If we have sold it and we realized that the sale has been done, at that point of time we will say the revenue recognized or the revenue realized. So we will make the records at that point of time when we will get to know that the revenue is recognized or the realized. Thus credit sales are treated as revenue on the day sales are made and not when money is received from the buyer. Okay, so it doesn't involve if credit sale are there, that will be our creditor, but of course we will record it in our records at the same time. So that is called the revenue recognition. As soon as we get to know that yes, revenue is generated, so it doesn't matter whether you have received the amount or not, you will enter it in your records. Number 8 is matching concept. The process of ascertaining the amount of profit earned or the loss incurred during a particular period or during a particular accounting period involves the deduction of related expenses also from the revenue earned during that period. The matching concept emphasizes exactly on this aspect. It states that expenses incurred in an accounting period should be matched with the revenue during that period. If revenue is generated, then the expenses incurred will be matched with that revenue generated. It follows from this that the revenue and the expenses incurred to earn these revenues must belong to the same accounting period. So the expenses and the revenues will be matched if they are performing in the same accounting period. Number 9 is full disclosure concept. Full disclosure. The informations provided by the financial statements are used by different groups of peoples such as investors, lenders, suppliers and other in taking various financial decisions, right? So in this we are talking about the reports. So reports are to be used by different groups to take the financial decisions. In the corporate form of organization, there is a distinction between those managing the affairs of enterprises and those owning it. Owner is the different part, and who those are managing, those are the different parts. If there is a very big organization, financial statements, however, are the only or basic means of communicating financial information to all the interested parties. It becomes all the more important, therefore, that the financial statements make a full, fair, adequate disclosure of all the information which is relevant for taking financial decisions. Okay, so this concept says if we are making any reports, so reports are very important to take further decisions. So of course the full disclosure means everything, every important transactions should be recorded there. Nothing should be hidden so that those reports would be reliable. So this concept says everything should be disclosed while creating the records. So number 10 is consistency concept. The accounting informations provided by the financial statements would be useful in drawing the conclusions regarding the working of an enterprises only when it allows the comparison over a period of time as well as with the working of other enterprises. So comparison should be done. On that basis, this concept works. Thus, both the interfirm and the interperiod comparison are required to be made. So within the firm, we should compare it with the previous accounting period. Also, the interfirm with other firms also, the comparison should be made. So on that basis, keeping in mind all the transactions, all the sources should be used. This can be possible only when the accounting policies and the practices followed by enterprises are uniform and are consistent over the period of time. So the consistency concept says the base which we are using, the sources are uniform so that the comparison would be easily can be compared with the firms and with the different accounting periods. Then only we will be able to take decisions, important decisions, right? The 11th is conservatism concept. The concept of conservatism, which is also called prudence or trust, faith, provides a guidance for recording the transactions in the books of accounts and is based on the policy of playing safe. The concept states that a conscious approach should be adopted in ascertaining income so that the profits of the enterprises are not overstated. If the profit ascertained are more than the actual, it may lead to distribution of dividend out of the capital, which is not fair as it will lead to reduction in the capital of the enterprises. So this concept says that everything should be fair, trustworthy, reliable. We should not use the false statements in the reporting, right? Or anything should not be fake or the false while we are creating our financial records. Because if we sometimes what the organizations do, they show the incorrect profit just to attract the investors. But what will happen in that scenario? They will have to pay the dividend out of the capital. So that will again will be the loss, right? So this concept says we should always show the correct picture. Doesn't matter at that time the organization is earning profit or loss, but we should always be fair while creating the records. Twelfth is materiality concept. Materiality concept. The concept of materiality requires that accounting should focus on material facts. Efforts should not be wasted in recording and presenting the facts which are immaterial in the determination of income. The question that arises here is, what is material fact? Now this will be decided by the organization. The materiality of a fact depends on its nature and the amount involved. Any fact would be considered as material, and the false statement just to attract the users will not be included here. If it is reasonably believed. Reasonably believed means we should have proper documentation, proper base, proper proof that its knowledge would influence the decisions of informed users of financial statements. So this concept says that the informations which we are using while recording of the financial transactions should be material and facts should be there. Nothing should be fake and immaterial data should not be entered while creating the records. Also, we should have the proper reasonable belief, any receipt or any proper documentation on which the users can easily believe while taking the financial decisions. Number 13 and the last concept is objectivity concept. Objectivity concept. The concept of objectivity requires that the accounting transactions should be recorded in an objective manner, free from the bias of accountants. If an accountant is saying something, we should not be biased of accountant and the others. Like for this person the records will be different and for that person the records will be different. They should not be on the basis of that. This can be possible when each of the transactions is supported by verifiable documents or the vouchers. So while doing any recording of the financial transactions, we should have the proper documentation attached, and we should always keep it safe if we need to maintain our records. For example, the transaction for the purchase of material may be supported by cash receipt for the money paid. If the same is purchased on cash, right? Or the copy of invoice copy and the delivery challan if the same is purchased on credit. In case we have purchased on credit, then we should have the invoice copy or any related document should be there. Similarly, the receipt for the amount paid for the purchase of a machinery becomes documentary evidence for the cost of machine and provides an objective basis for verifying these transactions. So this concept says we should always have the proper documentation on which basis we are doing our recording, so that nothing should be biased and everyone can easily trust on those informations. So you have studied the 13 generally accepted accounting principles or the concepts or the rules which are very important for an accountant for recording the financial transactions. Just go through all the slides and understand all these concepts once more. Because when you will go for the interviews, finance interviews, then of course these concepts will be asked. So that's all for today. I will meet you in my next video with the next important topic of 11th class accountancy book. This is the second chapter going on, so the remaining part we will cover in our next video. So stay tuned.
Also, don't forget to subscribe my channel to get the notification once I'll upload my new video.